Welcome to the JD Power AI and Insurance podcast, where we explore how artificial intelligence is reshaping the industry, from underwriting and claims to strategy and investment. I'm your host, Michael Vermillion. Today's guest is Galen Shaffer, principal at Eos Venture Partners, an early stage venture capital fund focused exclusively on insurance innovation. Galen brings a rare combination of experience. She led innovation strategy for Fortune 500 carriers at McKinsey, and now she partners with founders who are redefining what's possible through AI. We'll dive into what AI means for innovation in insurance, where venture capital is placing bets, and what traditional carriers can learn from the next generation of insurtech. So let's jump in. Galen, welcome.
Michael, thank you so much for having me here. It was wonderful to see you in Chicago at the JD Power conference and glad to be reconnecting.
Yeah, and also right. Thanks again for joining us in Chicago. That event went really well. So, well, welcome back. Welcome to the podcast. You just to kind of kick things off here. You have worked with some of the world's leading insurers on innovation strategy, and now you're on the venture side, helping shape the next generation of insurtech. So, maybe to start us off, can you tell us just a bit about EOS Venture Partners and your approach to investing in early stage insurance innovation?
Absolutely. EOS is an early stage insurance specialist venture capital fund. We're a team of 10 located across London, New York, as well as Los Angeles. We all come from the insurance sector. We believe specialization is critical to driving top returns in a highly specialized industry. So I think maybe a few things to understand about us, our sector appetite, our stage appetite, and our investor base. In terms of sectors, we focus on both insurance as well as adjacent sectors. So think, personal lines, commercial, life, supplemental health, major medical. But we also look at areas which are related to and overlapping the insurance sector and which frankly might have stronger exit multiples than the core insurance landscape. So think, wealth and retirement, cybersecurity, employee benefits. So, while we focus on insurance as our core specialization, we also invest in and look at areas which are sort of beyond the sort of core insurance vertical. In terms of stage, we typically lead at the Series A, which means we write checks of 7 to 10 million. The Series A is usually it's a fun stage to invest in because you have a little bit of data, you have product market fit typically landed, the executive team in place, but it's not yet enough of an established company where you really get this sort of narrow bid-ask spread that you get in the later growth stages. So there's still a lot of room for a specialist person to sort of dig into the early numbers, understand the market, and really have an informed perspective on how much this company is worth and where you believe the company's going in the future. In terms of our investor base, most of our investors are actually carriers and reinsurers. We have a close strategic relationship with them. They invest in us not only because of the financial returns we bring them as sort of a venture specialist fund, but also for the innovation returns, bringing them closer to the early stage, helping them gain additional market access and accelerate commercial partnerships with early stage companies.
So it's almost like a 360 connection there. That I would assume that gives you guys a bit of a leg up, and just in terms of just being so close to the industry.
We find it incredibly generative to be very close to
Hmm.
incumbent carriers. I mean, gosh, it's so helpful not only for sourcing. Sometimes of our LPs are like, call us up and they say, "Hey, we met this amazing company. We're
Mm.
not going to invest, but what do you think about meeting them?" We lean on them for diligence. It's incredibly useful to introduce an early company to one of our LPs and really get their unfiltered perspective on that company. And it's really helpful for them when they're thinking about what commercial partnerships might really move the needle. I mean, startups are really compelling. They're always sort of selling themselves, and having someone who's actively in the market, speaking with a variety of them, can really be a trusted counselor if someone's looking to lean into a long term commercial partnership. And so we find it helpful for us, our returns, as well as our investors.
So you have a really unique background, being a consultant to the industry and now working with startup founders. So how has that influenced the way you evaluate AI opportunities in the industry?
Yeah, that's a good question. I would say not many people move from McKinsey to early stage investing. I would say it's a bit more common to move into an operating role at an
Mm,
incumbent. I loved my time at McKinsey. I mean, you the firm taught me how to think. It taught me how to structure the world. It introduced me to some of the largest companies and some of the deepest connections who are still a core part of my network. I would say what that allows me to bring to the table, though, is a very different perspective than many traditional venture capital investors who may have worked at startups before or who may have worked in investment banking only before. I would say it brings a few things. One is a deeper, more nuanced financial perspective from a carrier viewpoint in terms of how much budget they actually have available to this type of solution, what really drives the needle in terms of a partnership that they're looking for, and also how would they even think about pricing to acquire something like this. I think sometimes people who are used to enterprise SaaS might not actually understand how a P&L of a carrier works. And I think that understanding is very helpful when I'm thinking about sort of early stage investments. In addition, I would say being pretty deep in operations is very helpful when you're thinking about, an early stage company's sales cycle, what'll make them successful, what are the indications of early success. I mean, gosh, at my time at McKinsey, I worked in call centers, I worked hand in hand with wholesalers, I worked on the claim side. I mean, that type of deeper experience at a carrier really helps you understand what's going to resonate with those buyer groups. Um, and then finally, gosh, I think it's helpful culturally too.
mm.
I think some people can be a bit flip when they talk about carriers and how slowly they move, but there's a reason many of these carriers have survived for, you know, decades, and that's because they have a careful approach to making these decisions about their core business operations. And I think that's something to respect rather than something to push away. And so I think it's been a significant advantage to have that type of background going into the early stage.
That's yeah, I think that's a really great point, Galen. So I want to talk now a bit about just connecting the dots between um, AI and innovation in the insurance industry. So, from your vantage point as a venture investor, how is AI changing the agenda, the innovation agenda for the industry? We know there's automation opportunities and cost saving opportunities, but what else?
Yeah, I guess first before we dig into this, I want to sort of open the aperture a little bit. And we talked about this a little bit at your conference, and I thought it was a really valuable discussion to say, very often when people talk about AI, they're using it as a shorthand for generative AI.
Got
Whereas
it. Yeah,
actually,
that's yeah.
yeah,
You're right. We should back up and let's kind of level set. And what are we talking about when we talk about AI? Let's define
right.
it. Yeah.
Yeah, yeah. And I think that there's a lot of, I mean, actually, McKinsey did some great research here, not to like pump my old employer too much, but basically, like, there are lots of traditional AI techniques that insurers use. And when you actually sort of break down the landscape, probably 60-80% of opportunities uh, should be powered by more traditional AI techniques. Think like machine learning, think like sort of traditional RPA or OCR techniques. And the actual sort of generative AI techniques probably only account for, I mean, their estimates is like 20 to 40% of the value from AI.
Mm.
Because, that type of technique where you're actually generating new content, it's very interesting, it's very valuable. It's not necessarily something that you would want to do if you're doing large scale analytics. It's something that's great around sort of ingesting unstructured data. It's something really powerful if you're thinking about developing new marketing material, speaking to a customer. But, not every hammer fits with every nail. And so, when I'm thinking about the innovation agenda at insurers, I always want to make sure that we're thinking about the right tool for the right situation at hand. And that sort of generative AI is incredibly helpful in some areas, but maybe not the tool you want to use all the time.
Just to kind of build on that point, one thing we're looking at are trying to help carriers better understand attrition risk and kind of what are the signals leading up to that. And we kind of know what they are. If you have a 14-year-old in your household who's about to turn 15 and get their learner's permit, that's going to trigger a shopping behavior. If somebody files a claim and then they get a 30% increase in their premium, that's going to trigger shopping behavior. But one thing we're looking at using AI for here is um, how do we kind of understand or maybe uncover signals that we hadn't thought of using AI? Would that be generative AI or kind of machine learning?
Yeah, I've worked with a few carriers who are sort of working on this on the actuarial and underwriting side. And I would say the most common technique that I've seen used most successfully is called an unconstrained generalized linear model.
Mm,
And basically, what you say is, hey, I have this massive set of variables here that I know about people. Like, let's just shake this around a little bit and like tell me what correlates with like attritional losses. And you can actually get really, really interesting results when you have that broad of an aperture. And then what you do is you then sort of back it up and you say, okay, can you turn this into sort of rating variables that I can submit to regulators? You know, which of these can I use? Which of these are accessible? Which of
mm,
these sort of don't uh, violate any particular protected classes? So, one actually really interesting data point, because you get these really fun data points that come up. One interesting data point that I've seen before is actually the amount that you spend on alcohol is highly correlated with how safe your home is.
mm,
And you always think, oh, that's like a little bit non-intuitive. But actually, if someone's getting, $1,000 bottles of wine, they typically do have temperature control. They'll have IoT systems in the house. They actually spend a lot of time at home because they're entertaining at home.
mm.
And so, and you can get that data pretty easily from credit card agencies and reporting agencies. And so that's a really powerful indicator. I think also, it's so funny when you think about home security systems, because a lot of people think, the State Farm investment in ADP and a number of other carriers are also sort of leaning into home security relationships, that it's actually about the safety of your home. And while that's it a little bit, one of the most important variables is how often are you home?
Mm.
Because if someone is home all the time, right? If you have someone who works from home or, potentially has children at home all the time, then you're much more likely to notice a leak situation.
Right.
If an electrical fire happens, you're around for that, right? The regular maintenance of your home is typically better taken care of because you're actively in use on your home. And so, actually, the hour someone is home is actually an incredible predictor of how safe their home is. So anyway, those are just a few examples, but it's definitely very interesting when you think about the unique data points that correlate with safety.
Yeah, I love the safety example. When you first said there's a correlation between alcohol and safety in the home, I'm thinking, oh my God, I've got way too many cases of wine in my dining room. But I'm glad to know that we have a safer household because of it. One thing we're seeing in our research, and this should be coming out this month, is that there's a direct correlation between agents thanking customers for their business on the phone and the intent to renew or likelihood to renew their policy. And so that would be perhaps like another signal. I know when I was in graduate school and they taught regression analysis, they always taught you that correlation does not mean causation, and therefore every potential correlation you're looking at should have a viable or some sort, yeah, I guess a viable hypothesis behind it. But I think with AI, we're going to kind of start connecting dots that we didn't weren't able to connect before, and it may take a minute to actually figure out. Oh yeah, that's why that's what the correlation is.
Yeah, yeah. And maybe to like dig into this a little bit more, when I'm really excited and thinking about sort of how generative AI can help us, I think I think sometimes we forget how much data insurance companies have locked away in unstructured data repositories
Hmm.
and how powerful it would be for pricing, for underwriting, for customer satisfaction if we were able to structure and analyze that data at
Hmm.
scale. And that's medical records, that's underwriting submissions, that's your first notice of loss very often, that's phone records.
Sure.
There are lots of
The
repositories
transcriptions of
we
the
have.
calls coming into the call center, right? Yeah.
Oh, yeah, exactly.
Yeah.
And then you could say at scale, actually, if someone says thank you, what does that correlate to?
Hmm.
And like maybe eventually you could get enough data to sort of determine causation. But the point is we just haven't had access to that in a structured way. And generative AI has huge potential to be able to revise that situation.
So, so I think people would be interested in what kind of your point of view from the work that you're doing as a VC in this area, what you're looking for. So at EOS, you're investing in early stage companies um, that at least some of them are using AI to reimagine parts of the insurance value chain. What makes an AI powered insurtech company stand out to you?
Yeah. Okay, I'm gonna start by being like a little bit of a downer, and then I'm gonna be more exciting. So I'm just gonna
Okay.
preview this as I walk through this. Okay. Um, I feel like the first thing we look at, not the first thing, but one of the most important things when we're considering investing in an AI powered company is understanding how the company will exit. If you're working in enterprise SaaS, you can dream big. You
Hmm.
can put like big, sexy valuations on top of things, right? Because like the company could go anywhere, the exit could be infinite. Like there are lots of billion-dollar companies out there when you leave the insurance landscape. But frankly, when you're investing in early stage insurance, I operate in a world of $400 million exits, right? Like my acquirers are Guidewire, they're Verisk, they're Applied, they're Vertafore, right? Most of them actually operate in the sub $100 million exit universe. And of course, there are exceptions to the rule, right? I mean, Triple C just acquired Evolution IQ for 730 million. That was great. That was beyond what I thought that they could do. And I think that is a very, very exciting acquisition path. But that is frankly sort of not the norm. And so when we're looking at a company in the insurance landscape, I like to say, like, if it walks like a duck, if it quacks like a duck, it's a duck,
Hmm.
right? And so yeah, sure, you're an AI enabled TPA, but fundamentally you're a TPA and you're going to be exiting as a sort of low teens multiple of EBITDA at best. And therefore, if I walk my math forward, how long will it take you to get EBITDA positive? What does that mean for your timeline for an exit? And am I investing at appropriate valuation that would give me the type of returns that I need for my LPs? And so what you have to do is you really have to sort of run out that math and say, given sort of a traditional or better than traditional insurance exit, where do I have to sort of put this company on a valuation spectrum? And I would say if a founder has previously been in an enterprise SaaS landscape, if they're living in Silicon Valley, if they're hot on that AI hype, usually we have like a bit of a misalignment of expectations.
Hmm.
And sometimes I have to really sit down with a founder and say, okay, let's walk it out. You're an AI enabled commercial broker, who might acquire you? An Aon, a Marsh, what would they pay? Okay, okay, you're really great. Let's bump up that multiple a little bit, right? But they're not paying 20x revenue, guys. Like I want to make money. I want to be aligned on the board with you making money, right? And so let's set up everyone for success here. And so that's a big part of when we look at companies, we invest for a successful exit. We don't want to be at crosshairs with these companies. So that's one thing. And that's like the least exciting thing, but I need to preface that.
Yes.
Um, the second thing that we definitely look at, right, is what I would call like excellence in the details, right? If you're an AI enabled company, that's great, but that means that you should be crushing your traditional metrics. Okay. When I look at the pilots that you convert to sort of full time partnerships, when I look at the wallet share you get, when I look at your contract expansion, your net retention, in some ways, if I cut out AI from every part of your pitch deck, what I should see are sort of market leading numbers in terms of sort of what your contract size and your retention, your traditional numbers look like. If you're an MGA, you better have an amazing loss ratio, right? And so in some ways, what I try to do is I try to strip away the window dressing of what someone is doing as an AI company and just say, given you're using this, I ought to see better capital efficiency and I ought to see better end results. And what do those look like? And I have to say, with a lot of the AI enabled companies I've been seeing, the capital efficiency is like off the charts amazing,
Mm.
right? Like I've been so impressed with the number of developers people have been able to bring in and the amount of time it's taken from someone to get from an idea to a product in the marketplace. I think that part of the equation has been blowing me away. The rest of it varies, like
Right.
it's here and there. That's why we're not back in sort of every company that calls us. But I would say across the board, I've been just blown away by the speed of companies being able to release with these sort of new technologies, Cursor, et cetera.
Yeah, it's interesting. Kind of back to your first point about not expecting large exits. I think that's interesting because the property and casualty insurance industry in the U.S. is so big. You have 800 billion a year in premiums. They're probably spending two-thirds of that on claims. So that's 60 billion or 600 billion on claims. The life insurance industry, the annuity industry, also very large. So what is it about this industry that kind of keeps the exit small? Is it just very fragmented in terms of the value chain?
Yeah, I think you've hit on it. I think it's a few things. One, it's incredibly fragmented. And I think people forget that when they look at the overall numbers. Like for example, Guidewire, I always forget this. Guidewire only serves the P&C sector.
Hmm.
Guidewire doesn't even touch life. And they've talked at a high level strategically, should we ever do life, but they see so much opportunity just in P&C. And so if one of your largest technology players in the sector doesn't even touch one of the largest lines, I mean, that says something about the amount of sort of specificity that you need to be very successful in a line. So, one, it's very fragmented. And you also see that when you look at even sort of personal and commercial lines. The specialty commercial players need dramatically different offerings from an underwriting workbench standpoint than the personal lines players do. We see dramatically different uptakes in sort of the types of companies that these guys are interested in. So one is the fragmentation. And then two is, the premium dollars are big, but you pay out a lot of that to the
Right.
policyholder. And so in some ways that like overstates the total size of the market that like insurers are dealing with. And so when you look at it, that's why you really need to understand like a carrier's P&L. Like, good example here. Like everyone thinks like life carriers should be really exciting on the claim side, but like you actually, even the big carriers don't process that many term life claims a year.
Right.
And so actually, most of them have relatively small operations around servicing, and their budget for servicing is not that large. Small companies could be built, but I've seen very few contracts that even touch $100 million for a SaaS player in term life claims operations. Sure, they might push money, but they don't touch it very often, and so it can be a relatively inefficient process. And so actually, the dollars that flow through the industry they don't necessarily collect with the carriers as significantly as you would think they might from the magnitude of the money.
Yeah, that's great perspective. I know earlier in my career I worked with one of the largest printing companies in the United States, and they told us don't get excited about the large numbers. 90% of what we spend is on paper and ink. So there's really only kind of 10% of it left to spend on anything else. So let's switch gears for a minute and talk about what carriers can learn from a VC who's in the insurtech space. So what are some of the areas that carriers can or should be leaning in harder, either building capabilities themselves in house or partnering with startups? And do the carriers run any risk of falling behind if they're not focused on AI?
Yeah. Um, so let me describe a few things that carriers do that I love and that are like very exciting for me when I see them, and a few things that I think make for a more challenging path. Um, I love it when a carrier has like a big, bold goal that's either owned by a business owner or the strategy team, corporate dev, innovation team owns it and sort of drives it in hand with this business owner, right? And it's usually very exciting. It's numbers focused and it has sort of a near term tracker that you can have. So, for example, a carrier I know said, I want 80% of my calls to be fully automated, like, period. All of them. And some of them are be really easy to automate, right? It's a password change, it's a zip code change, it's something like that. Others will be sort of more challenging. And that's why it's like an 80% goal. That's why it's not 100%. We want our humans to focus on the highest touch activities. But like putting that out publicly for their organization, committing to that, and then saying, maybe we'll use traditional AI techniques, maybe we'll partner, maybe we'll do some of that internally. But like that is the North Star I'm aiming for. That's just incredibly powerful as like a rallying cry for the organization because that then gives the strategy team cover to do pilots.
Right.
It gives the business leaders cover to say, hey, I'm gonna try this. Maybe our SLAs will be a little bit challenged during this period for this particular area, but like let's try it, let's iterate, let's do it. But it really aligns the organization.
As opposed to an organization that's saying if you're even thinking about using AI, you must get approval from compliance and legal and marketing, and you
Right.
need to write a memo and make a presentation, and just the complete
Yeah.
180 from that, right?
Oh, absolutely.
Yeah.
Or even some organizations that I know have very active AI arms, but the arms might not be doing work that's core to the business's P&L.
Hmm.
And a great example of this, something that drives me crazy, and no offense if someone's organization has done this, but if someone is building a chatbot knowledge platform so that way they can more easily access internal knowledge, like fine. Like, but that doesn't get me out of the bed at the end of the day in terms of what's going to impact someone's P&L.
Right.
And I'm like not clear how often internal employees are actually using it. And I'm not clear that you can actually draw a clear impact between a better internal knowledge management platform and the sort of core work you want to be doing as a carrier. It's a great early use case if you want to get your feet wet, if you want to touch early partnerships, right? Maybe it's a solid like single if I think about like a baseball metaphor, but I'd love to do it like a double, a triple, something that's like really meaningfully getting men on base and like meaningfully impacting my P&L, which is a clear metric aligned to a business goal and flexibility in terms of the hammers and nails that'll get you there. Knowledge management, I would say, just doesn't make my heart beat, Michael.
um, so in these conversations, we always like to kind of touch on lessons learned, and what people perhaps can kind of take away from some of the lessons that you've learned from your experience. So you've worked with startups, you work with traditional carriers. Any lessons around innovation velocity in general, or AI adoption more specifically, that you think carriers are perhaps still underestimating? I know personally, I believe that not just the insurance industry, many people are really not paying close enough attention to the velocity of AI and kind of the developments we're seeing on a weekly basis, and then kind of taking that, incorporating that into their future thinking.
Yeah. No, I think that's a great question. I'm going to go back to the baseball metaphor,
Okay.
okay? Which is
It's baseball season. I think the
baseball season.
Dodgers beat
Yeah.
my Guardians last night, but okay.
So what I've seen when I've worked with a number of innovation leaders, and this is across brokers, this is across life, about commercial specialty, across a variety of types, right? I think more carrier executives need to be focused on hitting doubles for your first innovation projects. There is a tendency to want to hit a home run
Hmm.
because in carriers, people have very long careers. You're somewhere for 15, 25 years. You finally stepped up to an executive role. You're the head of strategy. Your big movement's going to be generative AI. You want something that's going to crush it. Okay. And so the tendency is to aim for a home run, to look for perfection, and to overinvest in preparation before something sort of goes out the door.
So Galen, just to bring that to life, what
Yeah.
in your point of view, what would be the difference between a home run and a double
Yeah. Yeah.
in AI
So
terms?
I think specialty commercial underwriting is a really great example of this.
Okay.
And I've seen a number of leaders lean into full underwriting workbench replacements as one of their first movements here
Hmm.
to say, hey, I'm going to make a big partnership with someone like Send, someone like Federato, someone like Palantir, even, who's doing a lot of custom underwriting workbench replacements. And I'm going to have the most beautiful workbench. It's going to have intake that'll take unstructured data from both my emails as well as from sort of web scraping systems. It's going to sort of pull in. It's going to enrich that data with purchase data, but I'm only going to purchase it for some areas, right? I'm going to triage it throughout the process. Some of it will be sort of automatically quoted. Some of it will go to my underwriters. It'll be triaged in order of sort of when I want them to touch it. And then it will go beautifully into sort of a quote bind issue workflow. And you have this like incredible, maybe you'll have like one LOB that you'll focus on, but you want to basically do a rip and replace end to end full system. You want it to work with your Duck Creek claims system. You're going to be fully on it by next year. You're going to invest a few million. So it's like really just, and everything's going to be perfect. On the other hand, I have seen so much value from someone leaning into better NAIC codes.
Mm,
You know,
right.
right? You're a commercial underwriter, you do a lot of SME business. It is very hard to tell sometimes if a coffee shop serves booze late at night
Right.
and how they should be classified. And your risk changes a lot if you serve alcohol. And companies like Relativity 6, Sixfold, they are great at bringing a more accurate NAIC code to your underwriting.
Mm,
And that's the kind of project that you can implement 6 to 8 weeks
right.
and see dramatically different results very soon. And so that's a really good example of, everyone wants a sort of a big new workbench, but gosh, if you get a better NAIC code vendor in the system, that can have huge near-term impact and meaningfully change your underwriting. And I think more people should go for doubles like that.
That makes a ton of sense, and thanks for sharing those examples. I think that really brings it to life. So just to begin to wrap up here, I want to kind of look into the future, and with AI, I don't know what that means. Is that next week? Is that 6 months? Is that 12 in the next 12 to 24 months? Whatever your pick. But looking ahead, how do you see AI reshaping the structure of the insurance industry, whether that's product design, how we serve customers, how risk is priced? Where's AI going to have the biggest, or an area that AI is going to have a big impact?
Yeah. I think about this a lot from the consumer perspective as well as from the management perspective.
Thank you, and thank
With
you for that. We always want to here at JD Power. We always want to connect the dots back to the customer experience. So
Okay, well,
yeah,
I hope I'm going to say something helpful here,
okay.
which is which is that I feel like AI makes the default option more compelling than it was otherwise. It is great at giving you something quite personalized,
Hmm,
at understanding, hey, you're looking for a term life quote. We've done a great analysis of your paycheck, your mortgage, the number of kids you have. This is the sort of policy limit we would recommend you carry. Um, and it does that in a very compelling way. It can chat to you about it, it can pull in data. Um, and I think that we as consumers, and then we also as managers who are managing and taking in that sort of data and that recommendation, need to always bring a more critical lens to what is actually the input there. And is that the right decision for me and for my circumstances here?
I love that example because we know in our research that one of the biggest drivers of satisfaction is that consumer fully or completely understands their policy, like what's in it. And frankly, the industry's really struggled with this. It's pretty much nobody understands what's in their insurance policy.
Right. And I think about this actually as a California consumer
Hmm.
and my auto insurance quote. And I'm not going to name my insurer. I love them so much. They've been wonderful whenever I've had a call with them. I've been with them for 12 years now. But gosh, they should have told me at some point, hey, you ought to bump up your UIUM because
Hmm.
20% of drivers in California are not insured. And that was a fact I came across recently. And it blew my mind. And I realized I was completely uncovered. I mean, I had the state minimum, but the state minimum is basically nothing. So I
Hmm.
called my insurer, I bumped that up significantly. But I was just like, someone ought to have run that analysis and realized that, like, it educated me a bit more about it. And it's sort of sometimes incredible to realize that I operate in this industry, but I was taking on a significant risk that I didn't realize. And that a quick email when I had moved from Boston to California to say, hey, you should know
Right.
uninsured motorists are a significant problem in Los Angeles County. We would highly recommend bumping up this coverage.
Hmm.
that could have, I mean, I unfortunately did not have a claim situation, but that was a meaningful exposure that I didn't realize I was stepping into when I moved into this city.
So love the consumer experience example. Any other areas that you see AI having a big impact just in terms of the perhaps even reshaping the structure of the industry?
I I think we touched on this before, but I think in terms of risk pricing
Hmm.
and being able to use new, novel, and previously sort of unstructured and therefore held away pieces of data in order to better understand and price risk, I think that will be an increasing area of focus for insurers moving forward as well as for regulators who are hoping to better manage this going forward. I think that there's been some noise in the industry around the idea of, pricing for a customer of one. So bringing a sort of hyper personalized pricing and product understanding to the individual. And that in many ways like makes me uncomfortable. The point of insurance is to pool risk. And I think as we get smarter here, we always have to interrogate ourselves and saying, what actual risk pooling am I doing here? Who is being brought into this? And so I'm very excited in terms of AI's potential to be able to more accurately price risk. But I do think that there's a lot we need to keep in mind as we reach towards this horizon.
So we covered a lot of ground today. Is there anything else that we should touch on before we wrap up?
No, I've just really enjoyed this conversation. If anyone from the industry is listening to the podcast and wants to chat with me more, my inbox is always open. As I said, I feel like partnerships with incumbents is what really leads to our sourcing, diligence, and pricing edge as a VC. And I always welcome the conversation with more carriers.
Well, Galen, that was terrific. Thank you so much for joining us today.
Thanks for the time, Michael.
That was a compelling and practical take on where AI is taking the insurance industry, courtesy of Galen Shaffer. From how venture capital is shaping the next wave of AI innovation to what legacy carriers can do right now to stay competitive, Galen offered a rare investor's lens on the insurance industry's transformation. If you're thinking about where to innovate or who to partner with, this episode is a powerful guide. Be sure to follow or subscribe to the JD Power AI and Insurance podcast and share this episode with your teams in strategy, innovation, or tech scouting. I'm Michael Vermillion, and we'll see you next time.